In today's episode, we'll be discussing Amazon, the tech giant that has completely transformed the way we shop and consume content. Amazon is known for its wide range of products, providing a seamless customer experience. In addition to that, they have ambitious ventures like Amazon AWS, which has further solidified their position as one of the largest companies in the world. However, we can't ignore the fact that Amazon's free cash flows took a major hit. This is definitely cause for concern, but should we completely dismiss Amazon stock? Stay tuned to the Finance Dude to find out. Hey dudes and duderinas, this is the Finance Dude. Welcome to one of the most complete and exhaustive stock analysis on YouTube. Since this is a new channel, you can watch how my stock picking strategy works in full detail by clicking on the videos on the top right. In this episode, we have two missions. First, assess whether Amazon is a good business and has what it takes to move on to Analysis 2.0, and second, assess Amazon's valuation. Now sit back, relax, get ready for some top-notch financial analysis, and let's make finance fun. As always, I start this first approach with the 5 dimensions method, where I base my analysis on 5 different pillars: growth, profitability, solvency, valuation, and dividends. I won't bore you with every single metric in detail, but in the end, I'll show you the full table with the ratings. First up, we've got the first dimension, growth. Let's start with Amazon's remarkable revenue growth. Despite the recent deceleration, which is transversal to all the businesses I've been analyzing and that you can find in the top right, Amazon's revenues grew by an astounding 605%, from $74.5 billion to over $500 billion in just 10 years. It's truly mind-blowing and deserves a rating of 5. Next, we move our attention to net income growth, where we can't ignore the significant decline of more than 87% since 2021. Just look at that huge crash. However, upon closer examination, we find that Amazon has achieved a staggering 1,467.2% growth in profits over the past 10 years, averaging more than 30% per year. But given the huge crash in profits, I can't give them a rating of 5, you know that dudes. Hence, I'll give them a rating of 4. But the question remains, what caused such a profit crash in 2022? Now, let's take a look at Amazon's free cash flow growth. It's alarming to see a shift from nearly $22 billion in free cash flows in 2020 to a negative $24 billion over the last 12 months. Additionally, there's a significant disparity between net income and free cash flows. In 2021, net income was around $33 billion, but free cash flows were almost minus $22 billion. Moreover, current profits were approximately $4 billion, while current free cash flows were minus $24 billion. This raises some important questions. Typically, we expect net income and free cash flows to align closely. So, what could be causing this discrepancy? As investors, we want to see profits backed by strong cash flows. Ultimately, what truly matters is the cash a business generates, not just accounting profits. But rest assured, my dudes, if Amazon moves on to Analysis 2.0, your dude will thoroughly investigate this matter. For now, I rate this metric with a 1. Moving on to the second dimension, profitability. Let's begin with gross margins, which have shown significant improvement over the past 10 years. This improvement almost certainly can be attributed to Amazon's AWS, a segment with higher margins compared to their core business. Given this impressive progress, it deserves a rating of 5. Moving on to net income margins, we observe a positive trend until 2021. However, the crash in Amazon's profits led to a decline in net income margin. In 2022, it was negative at minus 0.5%. Although it has slightly recovered over the past 12 months, standing at 0.8%, it remains relatively low. Hence, this metric receives a rating of 1. Similarly, the free cash flow margin displayed a growing trend until 2020. However, with the crash in free cash flows, this margin tanked. It also disconnected from net income margin. While net income margins have recovered to positive ground, free cash flow margins remain deeply negative, at minus 4.7%. This is a worrisome indicator, leading to a rating of 1. Finally, let's examine return on invested capital. It's disheartening to witness a business that once generated over 20% returns on invested capital now struggling to achieve positive returns. This raises concerns and highlights the need to delve deeper into what transpired in 2021-2022 to impact Amazon's business. Currently, based on the information available, this metric receives a rating of 1. Let's move on to the third dimension, solvency. First, let's discuss the quick ratio. Throughout the analysis period, this ratio has remained relatively stable. Generally, we prefer to see this metric above 1. However, for capital-intensive businesses like Amazon, it's common for the quick ratio to be below 1. Nevertheless, the current level falls below the average of the last 5 and 10 years, warranting a rating of 2. Moving on to the debt-to-equity ratio, we find that it is consistent with the averages of the past 5 and 10 years, currently sitting at a healthy level. Therefore, this ratio receives a rating of 4. Next, let's examine interest coverage. This metric is calculated by subtracting yearly capital expenditures from Amazon's annual EBITDA and then dividing it by the interest expense. The current level suggests that the current capital expenditures exceed the EBITDA generated by Amazon each year, which is slightly concerning. What's also concerning is the fact that you still haven't subscribed to my channel nor smashed that like button. This metric receives a rating of 1. Lastly, let's consider debt to free cash flow. Once again, we encounter a cash flow problem. Due to the negative cash flows, Amazon is unable to cover its current debt. However, we've observed that Amazon is capable of generating strong cash flows, with a peak of nearly $22 billion in 2020. It is possible that this cash flow problem stems from excessive operating expenses and capital expenditures. If that is indeed the case, a reduction in these excess expenses would restore Amazon's ability to generate robust cash flows and address the poor performance of these metrics. But for now, rating of 1. Now let's delve into the fourth dimension, valuation. First, let's consider the enterprise value to sales ratio. The current multiple is below the 5 and 10 year averages, indicating that Amazon is in a much better shape in terms of valuation than it was back in 2020. However, it's not as favorable as it was at the end of 2022. We'll conduct a more in-depth valuation analysis in the following sections. For now, this metric receives a rating of 4. In a better shape in historical terms is the enterprise value to EBITDA multiple. This multiple gets a rating of 5. Once again, we encounter the problem of negative free cash flows, which impacts the price to free cash flows multiple. Given this, a rating of 1 is assigned to this multiple. Lastly, let's examine the forward price to earnings multiple. While the current multiple is below the 5 and 10 year averages, the current value of almost 80x is not justifiable. Nevertheless, purely based on a comparison to historical figures, this metric receives a rating of 5. As we conclude this 5D presentation, we address the final dimension, dividends. In the case of Amazon, since the company does not pay a dividend, metrics such as dividend growth, dividend yield, and payout ratio are not applicable and receive a rating of 1. However, there is one metric within this dimension that requires analysis: the number of shares outstanding. Unfortunately, Amazon has been diluting its shareholders over the last decade, with a 10% increase in the share count. This level of dilution is concerning and warrants caution. The only year where Amazon's share count decreased was in 2022. As investors, we prefer to see a company increasing our ownership stake rather than diluting it. Taking all these factors into account, this metric receives a rating of 1. Now, it's time for the summary table with every 5D component. Having concluded this 5-dimension section, we have arrived at a final rating of 2.38, a mediocre result. Typically, I look for businesses with a rating above 2.5 as a favorable indicator. Despite the current rating, it is important to recognize that if Amazon is able to return to its previous free cash flow levels, I strongly believe that the final rating will improve and will go north of 3. So, let's keep on with our analysis. But before we get to the juicy part where we dive into the company's valuation, I need a favor from you. If you're having fun watching this video and learning something new, please show some love and support to the dude by doing these 4 simple things. Subscribe to the channel, smash that like button, ring that bell, and spread the word to your peeps. Okay dudes, we're ready to rock and roll with this DCF valuation. Examining the historical averages of our DCF assumptions, it's hard to find a positive point. Revenue growth has decreased significantly, dropping from a 5-year average of 17.6% to a growth rate of only 2.1% over the last 12 months. With negative cash flows, there is no growth to consider, and both the free cash flow margin and the price to free cash flow multiple are not applicable. Additionally, Amazon has been diluting its shareholders over the past 10 years, except for a brief decrease in share count in 2022, which quickly resumed an upward trend over the last 12 months. Furthermore, since Amazon isn't generating positive free cash flows, it's hard to believe that they will initiate stock buyback programs. Despite the uninspiring results in the historical averages of our assumption variables, Wall Street analysts have a different perspective for the coming years. They are projecting an average growth in earnings per share of over 100% per year for the next 3 years. Insane. Is this a signal that Amazon is making a comeback? Additionally, analysts expect Amazon's revenue to surpass $700 billion in 3 years, representing a yearly growth rate of over 10%. Moreover, EBITDA is projected to reach $126 billion in 3 years, indicating a yearly growth rate above 30%. This suggests that Amazon's margins will expand. By doing a quick calculation, we find that analysts expect Amazon's net income margin to be approximately 5.5% in 3 years, which is the same as the margin in 2020 but still below the 2021 level of 7.1%. Nonetheless, the upward trajectory is evident, and the prospects are positive. However, I must note the following. While net income was already positive over the last 12 months, we observed that this was not the case with free cash flows. But since EPS projections are more widely available than free cash flow projections, I rely on them as provided by Wall Street analysts. Ideally, EPS and free cash flow numbers should align closely without significant discrepancies. Unfortunately, this is not the case with Amazon. But enough of talk, you all want to know my assumptions. Starting with cash flow's growth forecast for the first 5 years of the projection, I have chosen to be more conservative compared to the forecasts of Amazon analysts, opting for a growth rate of 40%. While analysts project a 100% yearly EPS growth for the next 3 years, it's important to note that free cash flows and net income numbers are currently significantly off. Also, estimating a 100% yearly growth for 5 years is different than estimating it for 3 years. Given this, I am confident that a 40% yearly growth rate for the next 5 years is reasonable and will put Amazon generating free cash flows of $61 billion in 2027, which is huge. If you have a different perspective or think my assumptions are flawed, please feel free to let me know in the comments. For years 5 to 10, I have chosen a cash flow growth rate of 12.5%. While we expect significant growth in the coming years as Amazon recovers from the recent crash in cash flows, it is not reasonable to assume the same level of growth once they return to the previous levels. Moving on to the assumption of shares buyback or dilution, Wall Street analysts are anticipating a return to profitability for Amazon, which could potentially lead to a stock buyback program. However, even during periods of high cash flows in the past, Amazon did not initiate buyback programs like we observed with companies like Google or Meta. Therefore, I believe the most reasonable choice is to assume a 0% growth in the share count over the next 10 years. Now let's consider Amazon's free cash flow margin. The highest value of free cash flow margin Amazon achieved was 6.8% in 2019. Currently, the margin stands at -4.7%, indicating a significant deviation from previous highs. However, as we have seen, Wall Street analysts are already anticipating a net income margin expansion to 5.5% in 2025. Although there is a current discrepancy between free cash flow and net income, I should note that this is a recent issue observed over the past 3 years. Assuming this problem will be resolved, I can envision a free cash flow margin expansion for Amazon. With the growing importance of Amazon Web Services in Amazon's business, which boasts higher margins compared to the core business, I will choose a free cash flow margin of 8% in 10 years. Finally, for the base case assumptions, I need to define a price to free cash flow multiple. Since Amazon currently has negative free cash flows, the current multiple is negative. However, since we are projecting positive cash flows in the coming years, I can choose a reasonable multiple of 17.5x. These are the assumptions for the base case. In the subsequent scenarios, I will make adjustments to reflect varying degrees of conservatism or optimism. After running the DCF model for each scenario, I obtained the following results. Starting with the base case, if we believe that the provided assumptions will materialize, the fair value of Amazon stock to have a 12% yearly rate of return would be $93.95. This represents a downside of -24.4% from its current price. You might think it's difficult to buy Amazon at these levels. However, it's worth noting that Amazon traded around this value for a significant part of the period from November 2022 to April 2023. This highlights the importance of keeping our analyses up to date and identifying comfortable entry levels for stock purchases. The assumptions for this scenario suggest that Amazon will be worth $2 trillion in 10 years. Back in 2021, Amazon was just a few $billion short from reaching a $2 trillion valuation. That's why it's crucial to look at the price before buying anything. If this scenario were to occur, investors could expect a 7.9% yearly rate of return by buying the stock at the current price. If that's your hurdle rate, then by all means, go for it. But be reminded that there are risk-free alternatives at around 5%, namely US Treasuries. To invest with risk, we must demand a good rate of return. Why 12%? The S&P 500 has averaged a 10% yearly rate of return over the past 50 years. By demanding a higher rate, we ensure that investing in individual stocks is worthwhile compared to invest in an ETF that replicates the broader market. This higher rate justifies the effort I put into analyzing individual stocks. Now, let's move on to the bull case. If we believe the assumptions for this scenario will materialize, we could pay up to $162.56 for Amazon stock. This represents a 30.8% upside from its current price, providing ample margin to have the required 12% rate of return. However, it's important to note that this scenario expects a 13.15% yearly growth rate in revenues over the next 10 years, aiming for revenues of $1.8 trillion, $162 billion in cash flows and a market cap of $3.2 trillion in 2032, not an easy feat. What do you think, dudes? Will Amazon pull this off? In the bear case, the assumptions indicate that we should only consider paying $56.12 for Amazon stock to achieve a 12% yearly rate of return. This represents a significant downside of -54.8% from the current price. Although the assumptions for this scenario might be too conservative, they are still plausible, especially in times of recession or economic struggles. Now, let's explore the extreme cases. In the extreme bull case, I assumed everything goes perfectly, like a fairy tale. This scenario envisions Amazon's cash flows growing at 30% annually for the next 10 years, along with a stock buyback program eliminating 1.5% of outstanding shares each year, and $2.3 trillion in revenues, $234 billion in cash flows, and a market cap over $5 trillion at the end of 2032. These assumptions may seem outlandish, so it's important to take them with caution. On the other hand, the extreme bear case assumes everything goes wrong. This scenario assumes Amazon continues to dilute shareholders, the market cap collapses to half of the current value, and free cash flow margins remain around 1.5%, which is extremely poor and a disaster for Amazon shareholders. But like the extreme bull case, this scenario is extremely improbable of happening. Now, keep in mind that these assumptions are just a first gauge of Amazon's valuation and don't incorporate qualitative information from more advanced analyses such as Analysis 2.0. Before making any investment decision, I would need to stress these assumptions. But for now, I hope this gives you a good idea of where Amazon stands in terms of valuation. This is the summary table with all the scenarios' price targets and probabilities. The probabilities I believe best reflect the scenarios are as follows: 60% for the base case, 24% for the bull case, 14.5% for the bear case, 1% for the extreme bull case, and 0.5% for the extreme bear case. Weighing these probabilities, the final price target for the stock is $106.35, indicating an overvaluation of 14.4%. This suggests that our required rate of return of 12% will not be met under these assumptions. Looking at the graph, we can see that the stock is currently trading in overvaluation territory. However, as mentioned previously, Amazon was trading at a fair price for a good part of the period between November 2022 and April 2023. But our work isn't done yet. Let's delve into the multiple valuation method to confirm these initial results. To determine a fair price for a company, we need to compare its current multiple to its 5 and 10-year averages. Upon analyzing the 5 and 10-year averages, we find that they have some unrealistic multiples. Therefore, it wouldn't be honest to consider them. Instead, I have personally selected more reasonable ratings for this analysis. By averaging all the prices resulting from the manual selection of each multiple, we obtain a price per share of $86.48. This represents a significant downside of -30.4%. This additional data point further suggests an overvaluation of Amazon stock. Now, let's wrap up this first analysis of Amazon's business by comparing the three different data points: 5 dimensions, DCF valuation, and multiple valuation. One of our missions was to assess whether Amazon is a good business and has the potential to move on to Analysis 2.0. The 5 dimensions revealed a mediocre business, with a final rating of 2.38. The significant decline in free cash flows is concerning. However, I firmly believe that Amazon's poor rating can be addressed if the company manages to restore its free cash flows to previous levels. Although easier said than done, considering Amazon's leadership in e-commerce with a market share of 40%, its dominance in cloud computing with a market share of over 30%, a strong customer base, and an innovative business model, I believe that the current cash flow problems are a result of investments in the future rather than a lack of capacity to generate better cash flows. It's worth noting that the issue doesn't lie in a higher cost of goods sold, as Amazon's gross margins have shown a positive trend over the past 10 years, earning a rating of 5. The problem lies in excessive operating expenses and capital expenditures, and if the stock moves on to Analysis 2.0, we will get deeper on this. Our other mission was to assess Amazon's valuation. Unfortunately, both the DCF and multiple valuations indicate that the business is overvalued. We also observed that Amazon's business was fairly valued during a significant portion of the period between November 2022 and April 2023. Considering all these factors, it's time for my final verdict. Despite the recent business struggles and apparent overvaluation, I have decided to pass Amazon to the next round, Analysis 2.0. We all recognize that Amazon is a behemoth, and I am eager to uncover the reasons behind its recent downturn. Specifically, I aim to answer the following questions. What caused the decline in Amazon's profits in 2022? Why are the free cash flows so disconnected from profits since 2021? Was there a significant increase in operating expenses and capital expenditures that contributed to this decline? If so, what are the goals behind these investments? In which segments is Amazon allocating these billions? Were my assumptions for the DCF valuation reasonable? If you can't wait for this second analysis, make sure to subscribe to our channel and turn on the notification bell so you'll be notified as soon as I post the video. Thanks for watching, and I'd love to hear your thoughts on Amazon's business. Leave a comment below and let me know what you think. Peace, dudes. You rock.